Aloha, this is Paul Brewbaker from TZ Economics in Kailua, Hawaii, or somewhere on the mainland, with part four of a four-part review of the post-pandemic economic experience in Hawaii. We've focused on disinflation and the role of monetary policy in recent years in part one. In part two, we talked about tight labor markets, and part three covered some topics in post-pandemic resilience. This final part four will focus on the legacy of remote work, dramatic change in the structure of the workforce, and related impacts in the housing market in Hawaii, and some observations about the supply side. Without further ado, let me bring up the slides and let's get into part four of this four-part review of post-pandemic Hawaii economy legacies. And I think I can minimize myself. And here we go. So the new thing this year was HR departments talking about RTO, return to office. An interesting moment, given that we have seen the benefits of remote work. If you go to Google Trends and search on the phrase working from home, indexed to the peak search volume, which was in March of 2020, you can see that pre-pandemic, the relatively low volume of searches on the phrase working from home, maybe 10% of the peak in March 2020 at the time of COVID onset. But today, post-COVID, it jumped and then subsided. Today, 4 years after pandemic onset, going on 5 in the next few months, we're looking at a volume of search on the phrase working from home that's roughly twice what it was pre-pandemic. So it's here to stay, and it continues to be pertinent in the workforce in Hawaii, and as we'll see with legacy effects in the housing market. So post-pandemic, about a quarter of Hawaii's workforce now report working from home, either full-time or hybrid, 1 to 4 days per week, and about 3/4 of it reporting never or almost never working from home. If you break down the same Census Bureau household pulse surveys from which these measures are obtained, you can see over the last couple of years a very stable pattern of full-time and hybrid workforce participation, around a quarter of the total. That is to say, it's looking like this thing is going to be around for a while. This is the new normal. This is what in labor economics and in international trade theory and whatnot is sometimes called a hysteresis, a change thought to be temporary, which turns out to be permanent. If you look across the patterns of working from home, you see that it is associated now, these are 2024 data. Working from home is more prevalent in households with higher incomes. Similarly, remote work is an increasing proportion of educational, an increasing function of educational attainment, which of course is associated with higher incomes. So by gender, you see higher participation in hybrid work by women than by men, which is probably correlated with higher remote work engagement in households with children, as opposed to households without children. So this pattern, these patterns, greater remote work associated with higher incomes, higher educational attainment, more with older than the oldest workers, more with larger than the largest households, slightly more hybrid work with women, significantly more full-time and hybrid remote work with associated with the presence of children in households is, as we saw, a relatively stable pattern that is the legacy of the post-pandemic return to work, and is related to patterns of home price appreciation and a spatial shift in housing demand that is also a post-pandemic legacy. So pre-pandemic, you saw appreciation rates for existing home sales prices on Oahu and in the neighborhood of 4 to 5%, slightly larger on the neighbor islands, but I'm going to focus mostly on Oahu because it's the urban core. Remote work shifted the pattern of housing demand outward from the urban core and to suburbs and exurbs and Zoom towns across America. But if you think about Oahu as an island, shifted housing demand from Honolulu's urban center, towards outlying neighborhoods, suburban neighborhoods. And as we saw in the earlier discussion on labor market outcomes, led many workers to exchange higher earnings for the amenity benefits of remote work, such as lower commutes or shorter commutes and the ability to engage more actively in childcare. As a consequence, single-family home prices on Oahu experienced a larger valuation overshoot above the pre-pandemic trend as things began to settle down in 2023 and 2024 than was observed in condominiums. More broadly, some of the literature nationwide suggests that up to half of U.S. home price appreciation in the post-pandemic era is attributable to remote work once you adjust for the other factors that help explain the dynamics of explain valuation dynamics. So the pattern on Oahu seems now to be well established. A jump in single family detached home prices relative to multifamily housing units, and that pattern initially had this spatial component of much higher appreciation in 2020 itself in neighborhoods on the North Shore, or Hawaii outlying neighborhoods in the North Shore, Hawaii Kai, East Honolulu, broadly, Windward Oahu, the highlands of Makakilo and Mililani, and actually negative appreciation, right? Decreases in prices in the urban core. At the median price point, so the middle of the home price distribution, you can see that jump in the post-pandemic trajectory for single-family home prices, a bit of an overshoot, some pushback, obviously, from monetary policy and rising interest rates. But throughout the Fed's monetary policy tightening and now pivot to monetary accommodation or reducing the tightness of its policy posture, single-family home prices on Oahu have continued to maintain a parallel track of 4% price appreciation on which single-family home prices had been rising during the pre-pandemic decade. So that's kind of significant. I thought maybe they'd go back to the old track, and you can think of that upward shift, kind of an intercept shift. I mean, such as it, may or may not persist. It's been a few years. You can think of it as a premium associated with the spatial shift in the pattern of housing demand associated with the ability to work remotely. Condominium prices have had more trouble sticking to the pre-pandemic trend. There was a surge in the low interest rate period of 2020 and 2021, a bit of a recovery actually for both single family and home condominium prices on Oahu, which had begun to fade actually in the pre-pandemic monetary policy tightening and the rise in mortgage interest rates that came at that time. When mortgage rates went back to 3% after the onset of COVID, it obviously boosted both market segments, but clearly condo prices have not experienced the same, upward overshoot or convergence to a higher than pre-pandemic path. And partly that's a structural factor owing to the hunt for short-term rentals that is ongoing now in county governments. We'll look at some data in a second where you can see that expressed in the condo market as opposed to the single-family market. But let me come back to that. An alternative data set is a federal housing finance agency data set which combines sales prices with the collateral valuations associated with any mortgage originated and then sold into the mortgage-backed security pools. So refinances, for example, in addition to purchases and sales as a source of valuation data. And then because these are observations that occur over time on the same property at different points in time, during which time houses are renovated or expanded and so on. It's essentially you can think of it as a quality adjusted valuation index, and it is an index. So in this case, I re-indexed the base to 2023. 2023 is 100, and then I've estimated a long-term stationary trend from the late 1970s through I think that's supposed to say 2022. I'm not sure. There's a missing zero there, and you can see what jumps out. I've adjusted. Did I adjust for inflation? Yes, I've adjusted for a quarterly interpolation of the urban Hawaii CPI-U, formerly known as the Honolulu CPI. And so you can see the housing bubbles, the valuation bubbles over the years. And finally, this remote work lift, which shows up again as an overshoot and a parallel shift in the real inflation adjusted trajectory of home prices, the slope about 2% rather than 4 or 5% once you adjust for consumer price inflation. So the durability of this post-pandemic outcome is notable. On the neighbor islands, the FHFA data don't go back quite as far, but have a very parallel expression relative to Oahu, with valuation cycles of much larger amplitude. So, for example, when you adjust for inflation, the post-pandemic remote work peak in neighbor island housing valuations, and these are combined single family and condo. On the neighbor islands, the condos are mostly in resort areas. On Oahu, the condos are mostly in the urban core. But notwithstanding that, the post-pandemic peak in real neighbor island valuations is essentially the same as it was at the peak of the subprime bubble, the overshoot of the subprime bubble, which is sobering if you're thinking about real valuations over time. But again, a stationary trend appreciation rate in a range of 2 to 2.5% after you've adjusted for inflation does come out of the data, and the shared valuation cycles are a confirmation that capital is mobile and that zero arbitrage conditions apply, at least more or less in the long run. But again, an enduring remote work boost or lift in valuations. We'll see how long it lasts, how enduring it is. Why larger on the neighbor islands? Possibly because of the presence of vagabond workers. So these are, I talked about the movement, the shift in the spatial shift in housing demand to suburbs and exurbs. Well, the neighbor islands may be Zoom towns. Maui may be a Zoom town. The other thing that people have been focused on recently, because of the post-pandemic inflation, the disinflationary uh, monetary policy tightening, the most severe monetary policy tightening imposed in about 40 years, uh, and subsequent pivot to normalization of monetary policy and initial moves downward in the term structure of interest rates, particularly at the long end of the Treasury yield curve and of mortgage rates up to a mortgage risk premium or call premium, if you will. Those movements of interest rates upward and downward, which I've illustrated here, is kind of inverted, but got the mortgage rate on the horizontal axis and Oahu existing home sales on the vertical axis to show the inverse relationship. Higher mortgage interest rates are associated with lower existing home sales volumes, with the notable exception of the V-shaped, very, very narrowly V-shaped collapse of home sales in the months following initial onset of the COVID pandemic. This is about 5 years of data. So I've started in 2019, run the clock forward through about, I want to say, yeah, mid 2024, second quarter, or these are monthly data, so June 2024. And obviously, as mortgage rates begin to decline, the expectation would be that home sales would start to rebound. Because of that inverse relationship, you could take the same data, invert the scale for mortgage rates. So on the right-hand side, I've got the 30-year fixed rate mortgage rate average in the US, running from 2% at the top and 9 or 10% at the bottom. So invert the mortgage rate and superimpose it with a 2-month lag over Oahu existing home sales, and you can really see how tight that relationship is. In this case, the anticipation of lower mortgage interest rates over the next 2 years or so would be expected to improve existing home sale volumes and sort of bring them back towards the low end of the range experienced in the 20 teens. And that's true in the statewide data as well once you incorporate Neighbor Island existing home sales in addition to those on Oahu. Just a note about affordability. I know a lot of people are concerned about it, and obviously, from a public policy perspective, um, it's very high in the ranking of things that people want addressed. I just want to remind everybody that there are three elements of affordability. One is obviously the price of the house, and that's what most people tend to focus on. But as you've seen in the previous slides, home price appreciation after inflation adjustment uh, does tend to converge on a long-term trend, which is kind of durable if you think about the real return to capital in the long run, which is rooted somewhere in productivity growth. Now, in Hawaii and Honolulu, or more broadly, when you look at the neighbor islands, yes, there are cycles of valuation cycles of large amplitude. Those are primarily rooted in the inhibition of supply response imposed by geographic scarcity, right? Steep slopes and water bodies, but also by regulatory scarcity. And we don't, policy can't change geography, but policy can change the regulatory environment. Prices are only one element of the affordability calculus, for which the other two elements are interest rates and income, right? So the problem of a shortage of housing is solved by building more housing. The problem of not having enough income is solved by investing in human capital so that you will have more income, right? So either invest in the physical capital, building the houses, or you invest in the human capital, making yourself more productive and more likely to have the income you'll need to afford the house that you want to live in. Those are two separate problems and they shouldn't be conflated, right? Not having enough housing means build more housing. Not having enough income means acquire the skills that will get you more income. Two completely different things. And then the third factor is interest rates. And yes, when you have a stable, low interest rate environment, because you have a stable, low inflation environment, as America did all through the 20 teens, everybody forgets that interest rates matter because interest rates are so low that housing in the 20 teens, in the last decade, while everybody's whining about affordability, was actually almost as affordable as it ever gets in Hawaii. And yes, I only have a half century's worth of data, but for the last half century, the two best periods for affordability were between the Japan bubble and the subprime bubble, and essentially for, certainly the early part and more broadly, most of the last decade. So if you missed the train, that's on you. And obviously, most recently, during the monetary policy tightening of the to deal with the post-pandemic transitory inflation event, interest rates went higher, and therefore, other things equal, given your income, given whatever's going on with home prices, a higher interest rates, a 500 basis point increase in the overnight rate, and I don't know what, like a 300, 400 basis point increase in the mortgage rate. Come on, that's going to make houses less affordable. And now we're waiting for those rates to come down. And I have no doubt that affordability will improve. That won't make houses in Hawaii any cheaper because Hawaii doesn't suck. If you need more houses, you got to build them. If you need more income, you got to figure out how to get it. But it is what it is. Hawaii is not a sucky place. I mean, and no offense to people who live in Oklahoma and Louisiana, and nice people and cheap housing. And this, I don't. Can you do there what you do in Hawaii? If so, think about it, right? I said a second ago I wanted to uh, just observe something interesting about the performance of the condominium market on Oahu relative to the single family market that's not obviously observable in the valuation data, but very much is a factor in the inventory data. So, unless you've been living in a cave, you may have missed the fact that every county council and the Honolulu City Council essentially want to ban vacation rentals. So that's their jam. Let's ban vacation rentals. So this is a very tight housing market, pre-pandemic, even post-pandemic, with 2 to 3 months of inventory going into Fed monetary policy normalization, higher interest rates, higher mortgage rates, slight buildup in inventories, and then comes at the end of 2018. There's a collapse in equity valuations. Trump's tariffs. Trump. You remember President Trump liked to call himself Tariff Man. Are starting to really bite. A tariff war has started between the U.S. and the Europeans, between the U.S. and China, and the stock market freaks out in October of 2018. And the Powell put at the end of that year, Jay Powell says, "Okay, we're going to stop policy normalization. We're going to restart policy easing, and interest rates start to come back down in 2019. And with them come the single family home price inventory. So the inventory pileup in both segments until Bill 19, as interest rates come down in 2019, that inventory built up a base in the single family market. But because now the Honolulu City County, City County, City Council is talking about some, forms of short-term rental regulation or, knock on your neighbors or whatever, investors in condos on the, Mauka part of White, right? The nice rooms are the Makai part of Waikiki. The not as nice rooms are over in the Mauka part, are on the Alawai side of Kuhio Avenue. And many of those short-term rentals in those condos, like Mauka of Kuhio Avenue, more on the Alawai Canal side, many of those investors say, "I'm out. They're gonna ban short-term rentals. I'm out of here." And you can see that inventory uh, build up or the inventories don't subside with the low interest rates that they did with single family homes. When comes the COVID onset, then you have 6 months of no travel, and there's another group of short-term rental owners, again, which mostly comprise condos in Waikiki on the Mauka side, on the Alawai side of Kuhio Avenue. Many of those investors now have no cash flow. There's no tourists for 6 months. They list their condos. They're trying to sell those condos. And then comes the low interest rate environment and the restoration of travel and tourism. And then comes revenge travel, or people's pent up demand for a Hawaii vacation after a year or two of wearing masks and social distancing leads the inventory to sales ratio for condos to converge back with the single family inventories, although by then the Fed's starting to raise interest rates and inventories are piling up yet again. Along comes Senate Bill 2919 a year ago down at the ledge. And once again, as soon as the ledge starts talking about expanding, so what the state SB 2919 was passed by the legislature, gleefully signed into law by Governor Green. He just loves this stuff. And as Act 15 enables the counties to just extinguish short-term rentals, right? It's just, I mean, there are going to be huge constitutional questions about, unconstitutional takings and private property rights and whatnot. But the ledge, in its infinite wisdom, says, fine, you want to ban short-term rentals, knock yourself out. So this legislation, even before it passes, right? As soon as they say, we're thinking about letting the counties wipe out short-term rentals. As soon as that happens, the condo inventories explode. Now, single-family home inventories have remained relatively stable, and I, anticipate that the market will tighten over the next couple of years as the mortgage interest rate comes down. But in condos, right? I mean, at least through the middle of this year or late in the summer, there's a train wreck unfolding, and I imagine, and I have actually calculated it, but not recently, that over on Maui and on the Big Island, where they just can't wait to ban short-term rentals, you have the same train wreck beginning to unfold. So we'll just have to see. That's the big question mark. And we'll have to see what happens there. Okay, that's a long diatribe about, be careful what you wish for. You want to create a glut of condos. I mean, sure, will it make them cheaper than they otherwise would have been? Yeah, you want to, you want to crush your auntie who inherited a condo from Tutu, who bought it in 1972. I mean, used to rent it out to UH students, and now it's a vacation rental because it's on Alawai Boulevard. Yeah, sure, crush her, crush auntie, right? Um, you see all of this wild stuff. You see, there's this argument that offshore investors make neighbor island housing less affordable, right? Like their existence, the fact that they're not local makes housing less affordable. Ooh, they bid up the price of housing. The only problem is on the neighbor islands for, the last 10, 15 years, going on 15 years, the share of local buyers has been increasing on the neighbor islands. The share of offshore buyers has been decreasing like 10 percentage points. So how could those guys be making housing less affordable if they're a smaller I mean, where do these people get this stuff? You know what I mean? Anyway, just, went down the rabbit hole here a little bit, but the labor market shifted dramatically. One quarter of Hawaii's workforce now works hybrid or full-time remote. Housing demand as a consequence of remote work radiated outward from the urban core to suburbs and exurbs, and maybe to the Zoom towns like, Maui. And combined with other shifts that are going on that we talked about here, the jump in e-commerce, the real estate fallout, commercial real estate fallout from the fact that office utilization isn't as high as it used to be, and maybe some commercial structure. People don't go to the mall as much. They don't go to the gym as much because they're not going to work. I mean, they're not commuting. So they're not stopping at the gym on the way home from work. They're not stopping at the mall because they've got Amazon Prime. And so we're now in a moment where not just in residential real estate, but in commercial real estate, people are looking at new uses for these properties. And that could be, that could be accretive to construction activity this decade. And then there are bigger changes going on in terms of media, connectivity, um, and the AI moment, which feels a lot like internet 30 years ago. And those cycles of building permit values adjusted for construction cost inflation are just as notable as the ones we observed in valuations. You could see the Japan bubble of the late 80s, early 90s, the subprime bubble of the early 2000s, the what I call the new urbanism of the 20 teens, right? Live, work, play, and then this kind of wobbly post-COVID sort of directionless sideways um, pattern that's in the data now through mid 2024. And these are constant dollar private building. So the cycle lives in private construction, right? The public does whatever the public wants to do. It's political. It doesn't. And this construction cycle is not obviously highly correlated with the business cycle as we know it. The shaded vertical areas are U.S. recessions dated by the National Bureau of Economic Research. So, sometimes recessions happen while construction is growing. And sometimes recessions happen because construction is going over the falls, like in the Great Recession in the post subprime bubble environment. Um, in the case of the pandemic recession, the uh, contractors and the building trades in Hawaii quickly established workplace protocols that would allow construction activity to continue to remain ongoing by adopting, social distancing and mask wearing protocols that mitigated some of the risk of COVID infection. The residential portion of the private construction mix does have a long history of data upon which we can rely. And you can see here in this decomposition of the underlying annual data since the mid 20th century into a cycle, a long-term super cycle, and then a non-cyclical component, which I've then further disaggregated into a nonlinear trend component, and the residual, what's left over, which is it's not pure noise because you can see that it's the residual component where the business cycle seems to live. Look at how many of the recessions, the shaded areas are U.S. recessions. Look at how many of the recessions are associated with V-shaped downdrafts in the residual component. That's where the business cycle is in the residual. But there's this longer frequency residential investment cycle that you can see distinct from the longer term trend, which was positive until the mid 1970s and has been negative ever since. And there's some demographic foundations for that, but there's also a regulatory component. They don't let you build basically. When you break out unit authorizations as opposed to constant dollar, you could break down the condo or the multifamily on the left from the single family on the right, and you can just see how single family home building has been crushed. At the time of statehood, almost 60% of households comprised married families with children. So if you're thinking of that world, you want single family homes where families can raise their kids and be close to an elementary school. And I mean, that was, leave it to Beaver. That was the world we lived in which only 12% of households comprised individuals living independently, and 60% of households comprised married families with children. Think about that for a second. Today, married families with children are less than a quarter of households, and the proportion of individuals living alone has doubled. So you need more households, even if nothing had happened. But these structural shifts, even if all that happened was the increase in independent living, you would have needed more households, and we're building fewer of them. We're building fewer houses. We are building a slightly larger share of condominiums, right? So single family homes have become less important, partly because they won't let you build them. Why are we stuck? Why are we stuck building fewer than 10,000 housing units per year? I mean, we used to build an average of 7,000 housing units a year in the quarter century from 1950 to 1975. We did that without computers. Dude, we did that with slide rules. You know what I mean? So, and when you look at these data, home building data, these are the statewide data once again. When you look at the data for the last 10 to 15 years, I mean, okay, first of all, the county's meant to do that. It's not an accident. And second, I mean, it's so good, only World War was worse. What? Seriously? Doesn't matter whether you're looking at Oahu and the neighbor islands, the pattern of regulatory compression is real, and it's a pattern of regulatory compression. Yes, the population is not growing as fast, but even if there had been no population growth, there certainly was household formation because of changes in the structure of the population. More older people desiring to live independently. And so we have a big shortfall that they're not going to let you, uh, remediate. If you look at land use, I mean, if you look at the state's land use classifications, there's been no meaningful change in the last 30 years. And as a matter of fact, even in the minuscule urban land district, only about 2/3 is even actively used in any use. So there's plenty of room to grow even within the urban land district. But I'm here to tell you, the state's never going to materially increase the amount of urban land availability. I mean, look at the data. Why would you expect that? Oh yeah, tomorrow is going to change. If you look at the visitor plant inventory, right, there are fewer hotel, condo, timeshare, and other, bed and breakfast lodging units in Hawaii than there were 30 years ago. Right? We don't live in a world where they let you build 70,000 lodging units. That was the world I grew up in. Okay? That world is gone, baby, gone. And as it is, the only net growth in Hawaii lodging, this is our biggest export. You know what I mean? The only net growth has been in the last 20, 25 years from undocumented vacation rentals seeking a pathway to citizenship. And the counties are looking to put those guys out of business. So we talked about this last time, or in part 3, where decelerating construction, decelerating tourism growth, decelerating GDP growth is over a half century to a century is validated in the data. And it's possible that the low-hanging fruit of post-war economic development, right? Airplanes, jet aircraft, right? That all happened. But now we got, internet, AI, where we're not going to do that. So a lot of what I think is, explains the diminution of growth comes from self-owns, right? We don't build highways. We don't punch tunnels through mountain ranges. And the active throttling of private investment, that's a real thing. Essentially, we cap capacity in many areas. And then it's fair to ask whether research and development and innovation are subject to diminishing returns. I mean, I see that in agricultural productivity, for which the 20th century was an astounding period. My dad was a plant breeder. In the course of the 70 years after he got his Ph.D., corn yields in America increased sevenfold. So by the time he retired from the UH at the age of 89 or something like that, it took 1/7 the amount of land to produce a bushel of corn as it did when he got his PhD in agriculture genetics in 1952. You got to think about that for a second. But can we keep doing that? Remains to be seen. Um, Either way, if we don't have population and labor force growth, and on top of that, we're not going to let people immigrate, um, only productivity matters. So we really need to be thinking about that. Most recently, with the wildfires on Maui, people have focused on things like how many vacant units are. Look, if there are vacant units, that means you have to build more units, right? These people say, well, we have plenty of vacant units. We'll just have the homeless people live in the empty mansions in Kapalua. Yeah, not, right? The homeless people aren't going to live on the 30th floor of a condo in Kakako because it's vacant, right? You got a vacant, they're going to have a property tax surcharge for vacant units. Hey, bucks for Lolo. The more vacant units there are, the more housing units you need to build that can be occupied. Come on. And when you break down these data at high frequencies, this is the final 4 or 5 slides here. Look at Oahu, look at the cycles, look at the trends. You see this over and over. Uh, I don't even know what this is. This is Oahu. What's this? Statewide. I got this in the wrong order. Neighbor Island, right? Big Island, Maui, Kauai. What's the diff? What's the diff? Right? Same, 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 same. I mean, basically, the cycles are the same. The trends end up the same. Yeah, it was different back in the day, but we don't live in that world. So, yeah, if you're young, good luck changing it. And please give it a shot because I'm here to tell you my Social Security depends on your fixing this problem. And with that, I'll say mahalo once again. That's the end of part 4. And have a happy Thanksgiving and a great holiday season. And I'll catch you next year. Aloha. Shaka.